Hello, everybody. My name is Christian Charlo. Welcome to this market report. Today, we're Thursday, June 25th, 2015. Today, folks, on the market, first of all, I want to talk to you about a follow-up on the last week market report when there was a clear bearish movement among oil equipment sector. A lot of stocks were breaking down, were shorting opportunities on marketgurus.tv that you can have access for free for 10 days just by clicking at the link below. We did recommend a pick among that list, and today I'm going to make a follow-up on that list, but also talk to you about an important decision that came out today in the US where the Supreme Court has approved Obamacare. And the fact that they have approved Obamacare actually created a bullish momentum among healthcare providers. So I'm going to show you the list of the stocks that are moving up and the stocks where you could actually start to build up some positions if you want to actually benefit from this decision that was made by the Supreme Court. Now, let's take a look at the oil and equipment sector. Last week, when we talked about this movement, we were around this area. We were clearly starting a clear bearish cycle in the oil and equipment sector. Now, the sector today is continuing to go down. Our pick on marketgurus.tv was CGES. We recommended that stock as a short on June 18. Now, since then, the stock make another breakdown because it was in a sideways formation, broke down again. So that's another short opportunity. But because we recommended that stock here as an analyst choice and on marketgurus.tv, today we're in a clear situation where we can take some profits. And if you have done so, be sure to take some profit on a stock like CGES. There was also other stocks that were staying in a neutral formation that could start a breakdown. Among that stock, there was 77 Energy, SSE on New York. Well, since then, the stock actually confirmed a breakdown, and look how much it lost today, 10.53%. So if you had shorted that stock, definitely you're in a situation where you can take some profit, and you should do so because right now we have reached this former support of April, and at this point we might actually start to have a stabilization phase. Now, with other stocks also that are breaking down, there was also Tidewater. Today, finally, Tidewater is breaking down with the pursuit of the bearish momentum. So right now, it's a clear short opportunity for a target towards the bottom of March, so around $20. So there's at least 10% to be made on a stock like Tidewater. Now, in the healthcare equipment sector, healthcare provider sector, there's several breakouts. So I'm going to show you here the list of the breakouts and the type of stocks you should avoid because the loss potential is greater. For instance, community health system, a clear breakout. Why? Because we had this important resistance and now we're clearly breaking out. But look how strong the stock is breaking out. It's surging by 12.16%. So if you're buying that breakout today, CYH in New York, well, folks, technically speaking, you're going to have to get out if ever the stock reverses its upward trend, and you're going to have to get out around 55. So imagine you buy that stock at 62 and you have to get out at 55. The loss potential is too great. So that would not be a stock that we would recommend on the marketgurus.tv and our analyst choice portfolio as a buy. Envision Healthcare, clear breakout as well, breaking an important resistance, however, already surging by 6.67%. And where should your stop loss be on the reversal of this upward trend? Around $38. So that makes it not less likely to be put among our analyst choice portfolio. HCA Holdings, same scenario, broke out an important resistance, surging already by 8.39%. Where should you put your stop loss? Below 82.50. So that would be too much of a loss potential, more than 10% on a stock like that. So it's kind of too risky to get into those stocks like that. Unless you open a quarter, a half positions, or you put a trailing stop loss. So if ever the stock loses 7% or more, you close that positions. That is a strategy, but it's all about potentially building up your positions on those stocks, and the risk is that those breakouts, this bullish momentum might deflate and you're going to have a big loss potential on those stocks. Now, what type of stocks should favor? Because all those stocks here like Community, Envision, HCA Holding, Tenet Healthcare are all explosive breakouts. The ones you should favor are stocks, for instance, like Molina Healthcare. Why? Because this stock is still neutral. So that could be a position, that could be a stock where you could start to build up your position. As an exit point, you have to put it around 67 because 67 corresponds to a solid support that has been tested many times, and you don't have a 10% loss potential. So that's actually more worth it. A stock like Express Script, still neutral. The thing is that if you're building up a position on that stock, where should your exit point be? Well, unless of waiting until 87, that would be too much of a loss potential. Consider this short-term upward trend there. So towards $90, $89 could be your exit point on a stock like Express Scripts. and you can get rid of it totally if it goes below 87. That's if you're willing to tolerate until 87. But if you're more risk averse, I would say 89 will be your stop loss. Select Medical, slight breakout, except it's only surging by 3.17%. The support is at $16, so there's not too much of a loss potential there. AET, the thing is, it's not a breakout. It's mostly a continuity of the bullish cycle, but you could trend trade that stock and put your exit point at 125 if ever the stock reverses this short-term upward trend. HealthNet stays neutral, so you could build up your long position there. 63 will be the exit point on a stock like that. And Centene still is neutral. That stock here still has an upward trend. Your exit point should be towards 77.50 on a stock like Centene.corp. So basically speaking, what this legislation does is that it doesn't allow states to discriminate against Obamacare because the Supreme Court say that it doesn't violate any law. And this is something that's going to be good for healthcare providers because they're going to be able to go in any states and actually pressure those states to make sure that they implement Obamacare, have a higher pool of potential people to insure, so more business for them. So among that list here, all those stocks you see that highlighted with an I are all stocks that you could build up your exposure there if you want to benefit from the bullish momentum that we have among healthcare providers. All those other stocks, CYH, EVHC, are all stocks that are breaking out. However, they're breaking out by more than 5-6%, 8% even on some of them, so which makes their loss potential really great. And if you have shorted some stocks in the oil and equipment sector last week, CGES was our pick on marketgurus.tv, and today it's a clear profit-taking opportunity. So that's it, folks. See you next week on marketgurus.tv. Facebook, Twitter, chat with us, share your strategies, and never forget, the more money you make, the happier we are. See you next week.